America's banking system is bleeding beneath the surface. While markets celebrate record highs, the foundation of modern finance is cracking. Silently, banks are now sitting on $650 billion in unrealized losses, $2.7 trillion in commercial real estate loans, and a growing wave of defaults that regulators can't contain. Liquidity is vanishing, confidence is evaporating, and every safeguard built since 2008 is showing fractures. What's coming isn't a single bank collapse. It's a structural breakdown of credit, trust, and solvency itself. This isn't fear-mongering, it's arithmetic. The numbers don't lie. The system that fuels the American dream is running out of lifeblood. The modern banking system runs on a paradox. It creates money it doesn't actually have. Through fractional reserve banking, every $1 deposited can become $10 of credit, transforming liquidity into leverage. This structure is efficient when confidence is strong, but it's catastrophic when trust breaks. Banks don't truly hold customer funds. They hold promises, backed by debt instruments and government securities that only retain value if markets remain calm. Once withdrawals accelerate, these safe assets must be sold, triggering losses that eat through capital buffers. The illusion of liquidity is maintained through overnight lending, a hidden web called the repo market, where banks borrow from one another to survive daily cash demands. In March 2020, and again in 2023, this market froze within hours, forcing the Federal Reserve to inject hundreds of billions just to prevent collapse. Today, those injections have evolved into permanent support mechanisms, the Bank Term Funding Program and reverse repo facilities. Quiet reminders that the system cannot function without emergency life support. This entire architecture depends on one fragile assumption, that deposits remain still. The problem is, they aren't. Since 2022, more than $900 billion has left regional banks, flowing into money market funds that offer higher returns and government protection. The result is a liquidity drain hidden beneath stable headlines. When reserves fall too low, banks borrow short-term money at rising interest costs, squeezing profits and pushing them closer to insolvency. The numbers prove it. Banks now pay 4.5% to attract deposits while earning only 2% on old treasuries bought during the zero-rate era. This spread guarantees losses with every transaction. What appears to be stability is a mathematical countdown. Liquidity is no longer abundance. It's evaporation disguised as control. And this fragile balance leads directly to the next crisis point, the era of free money that built this illusion in the first place. The seeds of today's banking crisis were planted during the years of artificial prosperity. Between 2020 and 2023, the U.S. economy absorbed over $6.3 trillion in stimulus, pushing deposit levels and asset valuations to historic highs. Interest rates were deliberately crushed to 0.25%, forcing banks to park their excess liquidity in risk-free government securities yielding barely 1 to 2%. Those bonds looked safe until the Federal Reserve reversed course. Within 18 months, rates jumped over 500 basis points, instantly devaluing trillions in fixed income portfolios. That was the invisible earthquake. The moment unrealized losses became structural. By early 2024, the FDIC reported $650 billion in unrecognized bond losses across U.S. banks, a number that doesn't vanish with time. It compounds as rates stay elevated. Small and mid-sized institutions, lacking diversification or derivative hedges, were hit hardest. They held long-duration treasuries and mortgage-backed securities that no longer trade at par. To liquidate them would mean insolvency. To hold them means slow erosion. Both choices bleed balance sheets in silence. This zero-rate era also engineered moral hazard. Banks, flush with free capital, expanded lending standards to maintain yield. Cheap money birthed fragile debt. Corporate buybacks, speculative real estate, and venture credit, each dependent on perpetual low rates. Once the cost of borrowing normalized, the system's excesses began imploding from the inside. The Fed's emergency programs masked the damage, but they didn't reverse it. The Bank Term Funding Program, introduced in 2023, allowed banks to borrow against these devalued securities at face value, a hidden bailout disguised as liquidity management. It postponed recognition, not resolution. This is why today's financial system looks calm. Losses are buried under accounting definitions, not cured by fundamentals. And as those cheap-era assets expire, they collide with a new, more dangerous threat: the implosion of commercial real estate, where rate exposure turns theoretical losses into real defaults. The illusion of stability that the free money era created is now being dismantled by the collapse of commercial real estate. When interest rates surged from near zero to above 5%, the entire property valuation model fractured. Overnight office buildings, shopping centers, and multifamily complexes that once justified billion-dollar valuations now struggle to refinance debt at double or triple their original interest cost. The result? A systemic margin call on an asset class worth $2.7 trillion, of which nearly 80% sits on the balance sheets of small and regional banks already under stress. Vacancy rates in key metro areas have surpassed 20%, while property income has fallen by as much as 35% since 2019. Morgan Stanley warns commercial real estate values could decline another 40%, erasing more than $1 trillion in paper wealth. But this is not merely a valuation problem. It's a liquidity collapse. Loans written during the era of 2% rates are expiring into a 7% world. The difference isn't a statistic. It's a trigger for defaults, foreclosures, and write-downs that ripple through every institution exposed to the sector. Between now and 2027, more than $2.2 trillion in commercial property debt will mature. Much of it cannot be refinanced without massive losses, because the collateral no longer meets lending thresholds. Each expired loan becomes a contagion vector, forcing banks to absorb markdowns that directly reduce regulatory capital. Even worse, these exposures are heavily concentrated. Dozens of regional banks have 30 to 50% of their assets tied to commercial property, meaning one wave of refinancing failures could erase decades of accumulated equity. What began as temporary paper losses has now evolved into tangible balance sheet destruction. This isn't just another cycle of bad real estate bets. It's the mathematical consequence of an interest rate regime colliding with an over-leveraged economy. And the first visible signs of collapse are already emerging as defaults quietly accelerate through the banking system's weakest layers. The cracks that began in commercial real estate are now spreading through the banking system like a slow, silent contagion. Defaults are no longer projections, they're measurable data. In the past 12 months, delinquency rates on commercial mortgages surged past 6%, the highest level since the Great Recession. Regional banks, such as Zions, Western Alliance, and PacWest, have reported charge-offs increasing by more than 40% year over year, while even investment-grade portfolios are showing early-stage stress. These are not isolated incidents. They are statistical confirmation that the next phase of the crisis has started. Every default sets off a mechanical chain reaction. When a borrower stops paying, the collateral must be revalued at current market prices. Values now down 30 to 50%. This instantly erodes a bank's capital ratio and forces them to raise liquidity or cut lending. Reduced lending strangles small businesses, employment contracts, and consumer credit weakens. As credit slows, defaults multiply, tightening liquidity further. This isn't speculation. It's the structure of debt compression repeating the same physics that detonated 2008, only this time the leverage hides behind regulatory definitions and delayed write-downs. Data from the Office of the Comptroller of the Currency shows loan loss provisions have jumped 35% in a single quarter, even as officials insist the system is sound. Behind those claims, the Federal Home Loan Bank System, the emergency lender for regional banks, has quietly issued over $1 trillion in advances since 2023, a volume unseen outside of crisis periods. These are silent bailouts disguised as liquidity assistance. The unsettling truth is that defaults are self-feeding. Every new loss erodes the collateral base supporting the next tier of loans. Each tier collapse forces more selling, more valuation resets, and more capital shortfalls. The contagion no longer needs panic withdrawals. It thrives on math alone. What begins as isolated charge-offs soon becomes structural insolvency, setting the stage for an even darker reality. where traditional banks offload risk into unregulated networks that hide exposure from public view. As traditional banks drown under mounting defaults, another financial structure is absorbing the risk, a vast, unregulated network known as the shadow banking system. It consists of private credit funds, non-bank lenders, and asset managers who operate outside the safety nets of regulation, deposit insurance, or reserve requirements. In the last decade, this sector has ballooned to more than $1.8 trillion in outstanding corporate and real estate loans, much of it financed indirectly by regional banks desperate to generate yield during the low-rate era. The danger is that these exposures never appear on balance sheets until the damage is irreversible. These entities borrowed short and lent long, just like traditional banks, but without the liquidity backstops that prevent collapse. As interest rates climbed, their borrowers, distressed developers, over-leveraged corporations, and speculative funds began to falter. Now, defaults in private credit are spiking by over 50% year over year, yet regulators cannot quantify the total exposure. The illusion of safety persists because this credit exists in private contracts, structured through layers of funds, special purpose vehicles, and opaque derivatives. When one fails, it infects the banks that lent to them through secured facilities, repo lines, or credit-linked notes. This is where the contagion spreads silently. Large financial institutions hold synthetic exposure to these private debts through collateralized loan obligations, CLOS, modern echoes of 2008's toxic CDOS. These instruments are bundled, rated, and sold globally, giving the illusion of diversification. In reality, they magnify systemic risk because the same underlying loans are often repackaged multiple times. The result is a phantom balance sheet, trillions in obligations that don't officially exist until defaults force recognition. It's not just leverage, it's invisibility. And as defaults intensify across commercial property and corporate credit, this hidden ecosystem becomes the accelerant of crisis. The public sees stable stock indices, but beneath the surface, shadow credit is collapsing in silence. What follows next is the most fragile fault line of all, the regional banking core, the weakest pillar supporting America's real economy. The weakest fault line in America's financial architecture isn't Wall Street, it's Main Street. Beneath the trillion-dollar balance sheets of global banks lies a network of 4,100 regional and community lenders, quietly carrying the majority of commercial real estate, small business, and consumer credit. These institutions finance nearly 70% of all construction lending and half of U.S. small business loans, yet they operate with the thinnest liquidity cushions. As deposits flee to money market funds and digital brokers promising higher yields, these banks face a structural liquidity deficit that no regulation can patch. Since early 2022, regional banks have lost over $900 billion in deposits, forcing them to borrow short-term from the Federal Home Loan Bank system and the Fed's emergency facilities. These lifelines come at a cost. Borrowing rates now exceed the interest earned on long-term assets, creating negative spreads that erode equity quarter by quarter. The facade of solvency survives only through accounting flexibility and delayed recognition of losses. A single credit shock or deposit exodus could vaporize thin capital ratios overnight. Unlike the megabanks stress-tested for global crises, regional lenders remain dangerously undiversified. Many hold 30 to 50% of total assets in commercial property and local business credit, sectors already under severe strain. When one regional institution fails, its loans are often concentrated within the same counties, triggering a localized credit freeze that ripples through payrolls, tax revenues, and property markets. This is not theoretical contagion. It's geographical concentration risk amplified by digital withdrawals. Modern banking runs don't start with panic at branches. They begin with a few keystrokes. As savers shift funds to safer havens, smaller banks are left strangled by shrinking deposits and rising funding costs. The survival of local banking, the very system that finances American jobs, farms, and towns, now depends on confidence alone. And confidence is the one resource that vanishes fastest when numbers no longer add up. The crisis building inside regional banks is quietly being absorbed by the giants that anchor America's financial system: JP Morgan Chase, Bank of America, Wells Fargo, and Citigroup. On paper, they appear unshakable. Each passed Federal Reserve stress tests projecting they could survive a 33% collapse in commercial real estate values and a 10% unemployment rate. But beneath that veneer of confidence lies a deeper, invisible vulnerability. These same institutions are entangled in over $200 trillion of notional derivatives, instruments that hedge interest rates, currencies, and credit spreads across global markets. Stability here is an illusion built on interdependence. If one counterparty fails, the entire network trembles. These megabanks hold liquidity advantages that make them appear secure, but much of that liquidity is synthetic, generated through repo agreements, swap lines, and balance sheet engineering. When market volatility spikes, this borrowed stability evaporates. The very derivatives designed to manage risk become amplifiers of contagion as collateral requirements surge and liquidity demands multiply overnight. The system's resilience isn't rooted in cash, it's rooted in complexity too vast to unwind. Adding to the fragility, these institutions have absorbed the deposits that fled regional banks, concentrating financial power into fewer hands. That centralization creates systemic single points of failure. If one major bank faces distress, the scale of its obligations means no bailout can be confined to national borders. The 2008 collapse of Lehman Brothers was a $600 billion event. Today, a similar disruption could involve 10 times that exposure through interconnected swaps and offshore funding chains. The illusion of strength rests on regulatory comfort, not on solvency. A liquidity crisis at a top-tier bank would instantly freeze global interbank markets and halt credit flows worldwide. The firewall between regional instability and systemic collapse is, in reality, made of paper labeled "too big to fail." And the next stress event will test whether that label still holds meaning when every protective mechanism is already engaged to keep the system standing. Every crisis eventually converges on the same institution, the Federal Reserve. It is both the firefighter and the arsonist of this unfolding collapse. After years of near-zero interest rates and quantitative easing that expanded its balance sheet to $8.8 trillion, the Fed is now trapped in an impossible equation. Lower rates to protect banks, and inflation reignites. Hold rates high, and balance sheets implode under unrealized losses. Every 1% change in policy rates alters the market value of bank securities by roughly $150 billion, meaning a single miscalculation can vaporize entire tiers of capital overnight. To prevent that, the Fed has quietly transformed temporary rescue programs into permanent lifelines. The Bank Term Funding Program, originally designed to stabilize markets in 2023, became a backdoor liquidity pipeline, allowing banks to borrow against devalued assets at face value. Over $160 billion has already been drawn from it, collateral that the market no longer values at par. This is not stability. It's suspended insolvency, masked by accounting definitions. At the same time, the Fed's reverse repo facility, once draining excess liquidity, is now reversing direction, releasing billions back into circulation to prevent funding shortages. These interventions prove one truth: the free market no longer clears risk organically. It is managed through central bank triage. The system survives not on growth, but on controlled distortion. But this balance cannot last. The higher-for-longer stance keeps inflation from collapsing, but corrodes the debt structure that supports every layer of finance, from treasuries to mortgages to municipal bonds. The Fed cannot solve both problems simultaneously. Every rate decision saves one pillar and sacrifices another. Monetary tightening has reached the point where each quarter-point hike transfers insolvency risk from households to institutions, from borrowers to lenders. And as liquidity operations expand to contain fallout, the illusion of control weakens further, leading directly to the next act of this financial theater: the government's desperate attempt to disguise fragility as confidence. When a financial system begins to fracture, the first response is not reform, it's theater. Regulators and politicians stage confidence while the numbers quietly contradict every word. The Federal Deposit Insurance Corporation, once a last resort safety net, now insures over $10 trillion in deposits with a fund barely exceeding $120 billion. To mask that imbalance, lawmakers have proposed expanding coverage from $250,000 to $10 million per account, an idea that reveals panic more than protection. No fund on earth can guarantee deposits when the underlying assets are worth less than the promises they secure. Agencies issue statements about sound banking conditions, yet their own data shows growing fragility. The FDIC's quarterly banking profile confirms that over 60% of institutions report declining net interest margins, while unrealized losses exceed $500 billion. Those are not temporary accounting gaps. They are systemic deficits waiting for a catalyst. Each reassured headline is a mirror image of 2007's subprime is contained. The words change. The mathematics don't. Even the credit rating agencies, the same institutions that misjudged mortgage derivatives before the 2008 collapse, continue to call the system stable. Moody's projects default rates will fall below 3% by 2026. Forecasts that ignore accelerating delinquencies and shrinking liquidity. Optimism has become a policy tool. Meanwhile, congressional committees debate cosmetic solutions, deposit expansions, lending facilities, and new capital rules, none addressing the core arithmetic of negative equity. The more guarantees they announce, the less credible those guarantees become. The government cannot ensure trust. It can only postpone its failure. This stage-managed calm has bought time, but not safety. Beneath the assurances, every new guarantee converts private risk into public liability. The losses of banks are being transferred silently to taxpayers, and when the accounting veil finally lifts, the illusion will dissolve into the one truth governments cannot legislate away. Confidence ends faster than liquidity can be printed, and what follows that loss of faith is not panic, but a systematic reordering of money itself. Every illusion has an expiration date, and the American banking system is approaching its own. The defaults rising across commercial property and corporate credit are not anomalies. They are the pressure release of a system that can no longer expand. As losses compound, smaller banks will be absorbed or dissolved, compressing financial power into the hands of a few global institutions. This consolidation will not restore stability. It will centralize fragility. Fewer banks mean fewer decision-makers, less competition, and more control concentrated at the top, an architecture perfectly designed for a digital currency era. As the Federal Reserve and Treasury intervene to contain the contagion, the next phase is already being written. The transition from traditional banking to programmable finance, central bank digital currency, CBDC proposals, once theoretical, are now being positioned as modernization. Behind that language lies a shift of control, from thousands of community lenders to one centralized authority managing credit creation at the national level. What began as a liquidity crisis is mutating into a restructuring of monetary power itself. The contagion will not end with failed loans. It will extend into sovereign debt markets, forcing policymakers to choose between devaluation and deflation. Each option rewrites the value of every dollar, every asset, and every savings account. The last illusion to fall will be that money itself is stable. When confidence breaks, policy becomes theater, and theater becomes chaos. The system that fueled decades of prosperity is now imploding under the weight of its own arithmetic. The banking crisis is not a cycle, it's a correction. The numbers no longer sustain the narrative. This is not about a few defaults. It's the end of an era where credit created prosperity faster than productivity. The reckoning will not be televised as panic. It will arrive quietly through policy, consolidation, and the slow replacement of freedom with control. The countdown has already begun.